Okay, I think we can start now. Hello, everyone. I'm Gayathiri from Index One, and I'm joined by Chris McHeffey and Cmiel from BX. Today, we'll be discussing index blended strategies and how asset allocation can help protect your client's long term investment portfolio from market volatility. In an unpredictable market, investors face significant challenges. With clients' financial plans spanning 30 plus years, effective diversification strategies are more important than ever. Our focus in today's webinar is on navigating market volatility and building portfolio resilience through index blending and asset allocation. We'll have time for questions after the presentation, so please submit your questions to the chat box as they come up. With that, Craig, could you walk us through why index blending has stood the test of time and which indices we should be watching right now?
Yes, thanks, G. Good to have everybody who's joining us today. I thought I would start this slide by talking about the evolution of the S&P 500. So the S&P 500 is the most well-known index in the world and consists of the 500 largest publicly traded companies in the United States. And each year, a couple of changes are made, mostly because one stock is falling out. One or two stocks might be falling out of the S&P 500 and one or two stocks might be taking their place. Or you could have a merger between two companies, thereby displacing one and they become one. So, but by and large, that's the definition of a static index. And so it just doesn't change much. It's not managed. It just sort of exists, and it's really a benchmark. And so that whole thing began in like 1970, where the S&P 500, eventually ETFs were created off of that. When we look at this evolution of products in tax loss harvesting, mutual funds were created, really back in the 40s, 50s, 60s, and continue to evolve. We're seeing them used less today than they were then as a percentage of assets, but there's still obviously a ton of mutual funds out there. This simply gave people a basket of stocks so they didn't have to put together their own portfolio. They could just buy 100, 200 stocks and have it actively managed. The kind of the negatives of that were the fees could run a little high. It wasn't personalized. You didn't feel like you actually owned stocks. And that led to the evolution of separately managed accounts. Separately managed accounts came into being because people wanted to actually have their own account. They didn't want to be in a pooled investment. And it could be, they could see what they owned. And so that really kind of emerged in the 90s and evolved through, the present day. The other thing that really started evolving in like the early 2000s were ETFs. So the challenge with a mutual fund or an SMA was it wasn't daily liquid. I mean, you couldn't sell it sort of in real time. So an ETF, you could obviously sell it in real time, and it just made the ease of getting in and out of packaged and pools much easier. That all led to kind of blending those three things together into direct indexing, which started, let's say, 4 or 5 years ago and is catching on. Direct indexing was really to say, give me the S&P 500, but I want to strip out the industries and stocks that I don't like. So I wind up with a basket of 200 or 300 stocks. The benefit of that is that I can actually see what I own. I can make changes to it, and I can tax loss harvest it. What we built with Index One is off to the right, what we call active indexing. So we work with really smart money managers from around the world who have active strategies, and we put those strategies into an index so they maintain all the benefits of mutual funds, SMAs, ETFs, and direct indexing. But what's actually in these portfolios is actively being changed based on factors, trends, momentums, etc. So that's sort of takeaway number one is like, hey, that's pretty interesting that we've created this whole new way of, in more elegant way, more efficient way of investing. And we're investing for performance, not just to hug a benchmark. So we would be remiss if we didn't take a minute to just look at how things have changed between last year and this year. So if we go to the next slide, we have prepared some benchmarks and some examples of strategies, and we see these in real time, and so it's interesting for us. By the way, BX and Index One are not money managers. We've simply created a very interesting platform for people to use, and we do a lot of due diligence and research on the index creators, the index managers, and we very selectively bring them into this combined platform. But obviously, the market last year had a great year. This is year to date as of yesterday's close. On the left-hand side are just some popular indexes and ETFs. So the bond market, the AGG, was up 0.7. Gold is the runaway leader, plus 26% as of yesterday. The EFA index, Europe and the Far East, is up 7.5% as of yesterday. And really, the international markets have been led by Europe. The VGK ETF is up 12% as of yesterday. The other stuff, not so well. The Dow was down about 7%. The S&P 500 down 8.5%. The NASDAQ, which led the market in 23 and 24, is off 13.5% year to date. The Russell 2000 continues to show that SMID and smaller caps continue to struggle. We did put in the VTV, which is the Vanguard Value ETF, is only down 3.5%. So this has been a good year to be more defensive in the U.S. markets. And then lastly, the MSCI is down 11%. So you've definitely got some winners, but you definitely have some losers. And so we were saying, okay, given that, what are we seeing in the universe of BX and Index One? And so these are not, they're tied to indexes on the platform, but this is just a general representation of what we're seeing. The EU large cap indexes that are on Index One and BX are up 13-ish% year to date. International equity up 4%. International leaders up 4%. US large value up 2.9. These are all as of yesterday's close as well. Low volatility, downside defense are doing what they're supposed to be doing, which is getting into a protective position with the increased volatility and questions around the markets and the economies. But anyway, the downside and the low vol are up 1.5 and 2.7%. And then generally speaking, our fixed income strategies on the platform are just barely up year to date, similar to the AGG. The things that are struggling this year, momentum, which was great last year, and growth, which was great last year. Each of those categories are down over 10% this year. And then the worst are the Mag 7, the tech, and the AI, which, depending on which strategy or index we're looking at, are down over 15%. By the way, the risk managed indexes and the dividend growers are about flat on the year. So that's also been a bright spot of preservation of capital. So that's sort of like, what are we seeing? And it really kind of lends to what Chris is going to go into next. And G, you're going to talk a little bit about, which is, all right, how do you navigate, a landscape that's changing so rapidly from year to year and quarter to quarter?
Thank you, Craig. Chris, could you walk us through an example of an index blend that should be in client portfolios?
Chris, you might be on mute.
I was, in fact, on mute. Welcome, everybody, to the lab here at BX. I'm happy to bring everybody kind of behind the curtain to give you a look at, constructing different models, which are blends of strategies, and then using those models to blend them to create comprehensive portfolio solutions that are likely to produce good risk-adjusted returns for clients in the future. And one aspect of, we think, successful portfolio management is to build durable portfolios that you don't have to adjust too much in the face of, I think GDP is going to do this, or I think the Fed's going to do that, because you can fall behind very quickly by kind of playing that game. But by kind of constructing portfolios the right way in the first place, you won't have to move them around too much. And there's ways that you can add risk management into your evergreen strategy so that your portfolios are likely to be cushioned a bit on, in a rocky market. So I'll start with our fixed income model, which I'm not going to create in front of you, but I just wanted to pull it up and demonstrate what it is. It's a blend of 3 of our different fixed income strategies. I know Craig had mentioned the term due diligence, but what we really look for, and we look really hard at a lot of strategies from around the world and only select what we think are the best of the best to be part of our platform. And part of that is, do we believe the methodology is durable? Do we think it's likely to hold up over time and deliver excess risk-adjusted returns over a market cycle, right? So what we've done here, and we can use this tool to optimize the blend of these strategies to get the exact right risk return outcome that we're looking for. But what I wanted to show you here was, these are all 3 fixed income strategies, and they're all created out of ETFs, and they rotate tactically. But look at this. So here's the correlation matrix. So the correlation between these 3 vehicles is 0.37, 0.33, and 0.58. Those are remarkably low correlation numbers. And one of the strongest pillars of risk management is diversification. Now, you can say the word diversification, but until you see the correlation between your assets, you don't know if you're really getting diversification. With numbers like this, you're getting remarkable diversification. Okay, so how does this blend hold up over time? Now, most people are going to compare their fixed income models to, say, the aggregate. So we're comparing this to the AGG ETF. Okay, so this is just a semi-annual rebalance of those fixed weights in this portfolio, and you see a result that is 3 times the return of the aggregate since 2017, with substantially lower standard deviation and a maximum drawdown that's like 40% lower. That's one of the things you can get out of having great strategies with low correlations to each other and blending them together. So let's take a look at another couple of examples that I wanted to show you today. So this is an all equity portfolio, and it's a very simple blend. It's easy to execute because even though it's a global equity portfolio, it's only got 30 total stocks in it. So it's accessible to just about anybody. And the 30 stocks are very different from each other, which once again provides you with some correlation benefits. So what we have is a high dividend, long-term dividend growth strategy, a US large cap momentum strategy. So the dividend growth strategy tends to be a value. The large cap momentum tends to be a growth. And the international momentum is obviously non-US large cap momentum. Once again, correlations of 0.55, 0.73, and 0.62 to each other, those are good diversification benefits. So how does that, what's the result of that? You can see the returns, but until you compare it to something, you don't really know whether that's successful. So with this, since it's global, I'm going to compare it to first the ACWI, because it is a global portfolio. And then I'm also going to compare it to the S&P 500, because a lot of clients might say, I don't care where on earth my stocks come from. I just want to do as good or better than the S&P 500. Okay, so you can see the resulting portfolio here. The blue line is the one that we've created from our strategies. 17% return versus 10 for the ACWI and 13 for the S&P 500. Okay, the standard deviation is actually reasonably lower, 19 versus 21 and 22. Okay, the maximum drawdown is a little bit higher, but most people would be willing to tolerate that in their equity sleeve for results that are this strong. So that's just, an example of just 3 of our models, very easy to execute. And then we're going to show you something that we've worked on a lot lately because people are looking for downside protection in this kind of market. So we've got this tactical model portfolio, which is a blend of 5 of our strategies. And they're very, very different from each other. 2 of them are long only, but they can go 100% to growth or 100% to value. And the other one can go from very defensive industries to very aggressive industries, just depending on market conditions. 2 of these sleeves can go to 100% cash. And then one is extremely broadly, globally diversified. So it's got a constant allocation to gold, bonds, and US equities, but then it can also add international equities, emerging market equities, commodities, currencies, almost any type of broad asset class you can think of globally. Once again, I'm going to come over here and look at my correlation matrix. It's looking beautiful, mostly in the 0.6s, 0.7 and 0.8. So that's pretty good diversification right there. Like I said, this is a reasonably aggressive portfolio because it's mostly going to be long equity, although it has the opportunity to move to cash. So how does this do versus an appropriate comparison? Demonstrating to the world how poor my typing skills are. So we'll compare this to, and I know this just from doing the work, but we can help you with this. And we work with advisors all the time to help create these kinds of things. So we thought this had similar risk to this 75-25 growth benchmark. And then we'll also compare it to the S&P 500. So returns well in excess of that's 75% Russell 3000, 25% aggregate. So almost double the return of that, and 60% higher return than the S&P itself. Standard deviation 13 versus 13. That's where I came up with the comparable risk level versus way lower than that for the S&P. But look at this. Maximum drawdown of 11 versus 22 or 23 for the 2 things that we're comparing it to. Once again, demonstrating when you have great products and you can put them together with other products that they correlate low, they have low correlation to one another, you can have just a fantastic result. So
Chris, let me just say one thing on that slide. BX rule number 1 is to determine what type of environment we're in. And so the slides that we were showing earlier, we saw the shift occur as we rolled into 2025, like what was working, what wasn't working. And so we could quickly identify what type of market environment we're in, which was value oriented and European oriented. What's interesting about this slide is rule number 2, which is protecting your drawdown, protecting your money. So, in this model that Chris has pulled up, its drawdown is half of the S&P 500. So, that's rule number 2. So 1, we got to figure out what are we dealing with? Are we in a bull market or a bear market? And 2 is how do we always make sure that we're protecting principal during market drawdowns?
Right. So, and this tactical model blends beautifully with a more traditional portfolio to create, even more diversification as well as a little bit of a downside buffer. So, okay, so let's just assume that we like that fixed income model, we like that equity model, and we like that tactical model. But in the real world, my client's got a risk score of 60, and they're a risk score of 50, and they need a 60-40 kind of portfolio. So what we can do is take all those sleeves and blend them together, which I've done here. That's not accurate. We have an ETF only version of the tactical portfolio as well for those who prefer to have a smaller number of tickers in their portfolio. So what we did here is we took a traditional 60-40 portfolio, which was our 10-10-10 equity sleeve and our fixed income model that we just created for this audience, and then took 20% out of the equities and put it into that tactical model. Right, so let's come over here, because at the end of the day, what we're really trying to do is help our clients' financial plans come to life, which means clients have a successful retirement, they have the dream wedding, they buy a boat, they do whatever it is they're dreaming of doing. And the best way to do that is to give them better returns at any given level of risk.
And avoid big drawdowns while you're retired.
Yeah, that's critical too. So we're going to take this. So the 60-40 moderate benchmark that we use falls right into that moderate category based on whatever risk scoring system that you tend to be using. So we're going to compare it to a 60-40 US moderate benchmark, which is a 60% SPY, 40% AG. Okay, so the demo model blend that we just created has about 600 basis points of excess return at a very similar level of standard deviation and a very similar maximum drawdown to that moderate benchmark. Obviously, clients are going to get to where advisors want to get them to their goals a lot more quickly at 13% than at 8%. So that's just the kind of thinking that we apply. It takes a lot of work to source these strategies, to find them, to vet them, to due diligence them. We've done all that for you. So when you see it on our platform, you at least know there's been a lot of work done on your behalf already. And we stand ready and willing to work with you to go to the lab and create outcomes like this that you're comfortable with to help you employ for the benefit of your clients. And I think that's all I'm going to talk about for now with the model portfolios, G.
Thanks, Chris. That was really helpful. That's very insightful. I will say Index One is very excited to be the index calculation provider for these strategies at PX, as it gives us a first-hand look at how they're being used to manage volatility in client portfolios. Given today's market conditions, asset allocation strategies like these are more important than ever. At Index One, we're proud to support money managers by calculating these innovative index strategies and by keeping investors informed on market trends and responses. Our ability to track performance and help advisors offer their clients the protection they need through strategies like the ones we've discussed today is what keeps us a trusted index provider. I hope advisors leave with valuable knowledge and inspiration on index blended strategies and how to apply them to client portfolios, helping them better navigate long-term investment goals in an ever-changing market. We're now moving into the Q&A portion of the webinar, so please feel free to submit your questions in the chat box and we'll address them as they come in. In the meantime, Chris, how would you use these models, like the ones you've shown today, to come up with an alternative approach to 60-40?
Well, I think we just kind of demonstrated that, where we don't believe that settling for the S&P 500 or the Russell 1000 is necessarily going to be the right solution for clients, but it takes a lot of work to find ways to do better. And then it takes some more work to find ways to take the things that do better and make sure that correlations are diverse enough to create better risk-adjusted outcomes. And it's really about training ourselves and our clients to think a little bit differently at the world. Maybe stop comparing everything to the S&P 500, because at the end of the day, that's not going to get my client to retirement. What's going to get my client to retirement is good risk-adjusted returns. So thinking about it that way, rather than how we do versus the S&P, is probably a good place to start.
I would add to that everything we do as a BX Index One team is dynamic. So all the strategies that Chris and I were going through earlier, by and large, they're rebalancing or reconstituting quarterly, in some cases more frequently than that. And so you're continually upgrading, in theory, what stocks and what bonds you're invested in. And so what's really important for us is, as Chris was alluding to, is finding the best ingredients. So what really allows us to have confidence to say that we really want to manage drawdowns and improve returns is that we're selecting the best ingredients that go into these strategies that are then all dynamically updated at least quarterly. So it's different than, your question of 60-40 is not overly dynamic. I mean, really, all you can do at that stage is just reweight those two things. Whereas our approach is we're going to not only reweight them, but we're also going to dynamically improve the ingredients in the 60 and the 40.
That makes sense. And how would you say advisors typically use factor indices within their portfolio strategies and in index blends like the ones we've discussed today?
Well, so we work both internally and externally over a variety of different factors. And what's interesting about that question is what the factors that are working now are different than the factors that worked the last 2 years. So the factors of growth and momentum were working. Now what's working is low volatility, value, dividend growth. So the perch that we sit on is to say not one factor is going to work all the time. So we try to employ the best factors to deliver the best results in up markets or down markets. But from the client standpoint, they want the best return, right? And so therefore we need to kind of blend them appropriately together in order to get the best risk-adjusted return for the client.
And I would add a little bit to that, which is that, many of our strategies employ what feel like traditional factors, but our index managers typically take a very different approach to the canned textbook definition of what that factor is. They define momentum or trends differently. They define value differently. And that enables kind of component of our value proposition.
Awesome. Thank you both so much. To everyone watching, you can explore all the BX models mentioned in today's session on both BX's and Index One's websites. In the meantime, be sure to subscribe to our email newsletters to stay updated on our next video content. Thank you for tuning in, and we look forward to seeing you next time. Thank you, everyone.
Thanks all.